Everyone says the stock market creates millionaires, but almost nobody tells you which investment actually did it. One choice looks exciting, the other looks almost boring, yet over 30 years, one quietly leaves the other behind. And once you see the real math, you may never invest the same way again. Imagine two friends. They both start investing on the exact same day. They both have the same salary. They both save the same amount every month. Neither of them is born rich. Neither has insider information. Neither is a financial genius. The only difference is where they decide to put their money. One chooses individual stocks. The other chooses index funds. At first, the stock investor feels smarter. Every morning starts with checking prices. Every headline feels important. One company beats earnings, another suddenly crashes, a CEO resigns, a new product launches. Every day feels like a puzzle waiting to be solved. It feels exciting, it feels productive, it even feels like investing. Meanwhile, the index fund investor does something that almost looks lazy. Every month, money goes in automatically. No searching, no predictions, no emotional decisions, just quiet consistency. From the outside, it almost looks like nothing is happening. But this is where investing becomes surprisingly psychological. Because humans naturally love action. We feel like doing more should produce better results. We believe working harder means earning more. And that belief follows us into investing. If buying one stock feels good, buying 10 feels even better. If checking your portfolio once is helpful, checking it 20 times must be even smarter. Except the market doesn't reward activity. It rewards good decisions repeated over long periods of time. And that's where many investors accidentally sabotage themselves. Let's imagine both people invest $500 every month, year after year. No skipping. No increasing the amount. Just consistency. The stock investor spends hours researching companies, reading earnings reports, watching financial news, following experts online, trying to find the next big winner. Sometimes it works. A stock doubles. Confidence grows. Risk suddenly feels smaller than it really is. So larger bets begin. But markets have a way of humbling confidence. One disappointing earnings report, one industry slowdown, one unexpected recession, and years of gains can disappear much faster than they arrived. The emotional cycle begins. Excitement, confidence, fear, panic, regret, then hope. And the cycle repeats again. Now look at the index fund investor. There are no dramatic victories, no thrilling headlines, no stories about finding the next Apple before everyone else. Instead, hundreds of companies quietly work on their behalf. Some businesses struggle, others explode in value. The failures gradually disappear. The winners naturally become a larger part of the index. Without making a single decision, the portfolio quietly evolves with the economy itself. This is something many beginners misunderstand. An index fund isn't betting on one company. It's betting that over long periods, human innovation continues. Businesses grow. Technology improves. People keep buying products. And economies continue expanding. Instead of asking, which company will win? It asks, what if I simply own all the winners? That's a completely different game. Now let's talk about the math. History has shown that broad stock market indexes have produced roughly around 10% annual returns before inflation over very long periods. Not every year. Some years are incredible, others are painful. But over decades, the average has remained surprisingly consistent. Now imagine investing $500 every month for 30 years. At first, the account barely grows. The first few years can actually feel disappointing. You wonder if investing is even working. Then something interesting happens. The money you've already invested starts earning money of its own. Those earnings begin earning more earnings. And eventually, growth starts accelerating. This is compound growth. It's often called the eighth wonder of the world. Not because it's magical, but because it feels invisible until suddenly it isn't. Near the end of those 30 years, your investments may be growing by more in a single year than you contributed yourself. That's when people finally realize time was doing most of the heavy lifting all along. Now here's the surprising twist. Many professional fund managers, people with teams of analysts, powerful computers, and access to enormous amounts of research, still struggle to consistently beat simple index funds over long periods. Not because they're unintelligent, because markets are incredibly competitive. Every opportunity is being searched for by millions of investors at the same time. Finding bargains becomes harder every year, which means trying to outsmart everyone else often becomes an expensive game, especially after taxes, especially after trading costs, especially after emotional decisions. Does that mean individual stocks are bad? Not at all. Some investors build enormous wealth choosing great companies. The challenge is knowing which companies those are, years before everyone else does. That's much harder than social media makes it look. For most people, the biggest investing advantage isn't intelligence. It isn't predicting the next big company. It isn't checking charts every hour. It's simply staying invested, ignoring the noise, continuing through crashes, continuing through recessions, continuing through uncertainty. Because every major market decline in history eventually became just another chapter on a much longer chart. The people who benefited the most weren't usually the ones making the smartest prediction. They were the ones who refused to quit. So, if your goal is excitement, individual stocks can certainly provide it. But if your goal is quietly building wealth over decades, the boring option may actually be the most powerful one. Because real wealth rarely arrives with fireworks. It usually arrives through patience, consistency, and giving time the chance to work. That's the real math behind index funds versus stocks. And once you understand that, you stop chasing the next winner and start letting the market work for you. If you enjoyed this breakdown and want more videos that simplify investing, wealth building, and the psychology of money with real numbers, not hype, subscribe to the channel. Because sometimes the biggest financial advantage is simply understanding the math everyone else ignores.